In this video, I would like to introduce you to one of the most important indicators used by institutional trading parties, the VWAP. VWAP stands for Volume Weighted Average Price. You can think of this indicator as being similar to a normal moving average. However, there are some significant differences. The moving average always includes a fixed period of candles in its calculation. For example, a 50-period MA calculates the average price of the last 50 candles. When a new candle is created, one candle is dropped from the calculations. Furthermore, only the market price is included in the calculation. The closing price of the respective candles is usually used for this. The VWAP, on the other hand, always has a fixed starting point from which it is calculated. This never changes. If a new candle is created, it is included in the calculation, but the first candle does not fall out of the calculation. Another difference is that the closing price of the candles is not used for the calculations, but the lowest price plus opening price plus closing price plus highest price divided by 4. Thus, the average price of the candle is used. The biggest difference to the moving average, however, is that the volume of the respective candle is included in the VWAP calculations. Candles with a higher trading volume have a correspondingly higher influence on the movement of the VWAP than candles with a lower volume. The exact calculation basis is VWAP is sum of volume times price divided by sum of volume. The VWAP visualizes accordingly the average price that market participants have paid for the markets in a given period of time. As a US-based fund manager once aptly put it, it is the price that the average naive trader pays for the market. That may be a bit harsh, but the fact is that for this reason, the VWAP is the most important benchmark for institutional traders to determine whether they have bought or sold at a good price or not. Imagine the following situation. You are an employed trader at a large hedge fund. In the morning, your superior, a senior manager, comes in and gives you the order to buy 20,000 contracts of the GC gold futures during the course of the day. Of course, you don't have the option of simply entering 20,000 contracts into your trading software and click buy at the market. You would instantly cause the market to skyrocket and, above all, completely ruin your own price because there are far too few limit sell orders at the nearby prices to match your market buy order. It is also not possible to simply create a limit order for 20,000 contracts and wait for it to be picked up. Other market participants would see this gigantic order in the order book and simply position themselves in front of you. The so-called front-running algorithms ensure that your desired price will probably never be reached. So you have to be creative and build up the order in pieces throughout the day to avoid attracting too much attention and, above all, to prevent the price from moving too abruptly against you. At the end of the day, your supervisor can easily determine whether you have done a good job by looking at the VWAP and comparing it to your average purchase price. If it is above the VWAP, then you bought on average at a more expensive price than the average naive trader got. This does not speak for your performance. However, if you have bought below the VWAP on average, your manager will be happy and you will get a fat bonus. So here we are looking at the intraday time frame, which is why the best known and most widely used VWAP is also the daily VWAP. However, things get much more interesting for us when the position sizes we are talking about become much larger and the order has to be built up over several days. In this case, the so-called Anchored VWAP, or AVWAP for short, is used to determine the average price the market participants have paid for the market during a trend movement. Understandably, this is also the price at which institutional trading algorithms become active in order to push ahead with a build-up of positions in the directions of the trend. Let's take an uptrend as an example. When the price returns to the anchored VWAP, which is set at the low of the upward movement, it can buy more at the cheapest possible price before the average buy position of the trend slips into the red and thus the trend comes under pressure. For level of interest, we initially include three important benchmark prices: the closing price of the previous day's VWAP, the closing price of the previous week's VWAP, and the closing price of the previous month's VWAP. All three are not only very powerful levels to which the price sometimes reacts very negatively, but first and foremost, they are essential benchmarks for determining who is currently in control of the market, buyers or sellers. For example, if the price is above all three levels mentioned, we can clearly assume that buyers are currently in control and we are well advised to position ourselves with them. Important anchored VWAP levels from higher level timeframes are also taken into account in our analysis and can serve as important support zones in the direction of the higher level trend.